Morning, everybody, and thank you so much for joining us this morning. Just to introduce myself, my name's Alan Yates. I run the distribution side of the business. With me today is Anton Smith. Anton's one of our investment analysts. Anton's been with us for about coming on 9 years. And hopefully today we're just going to give you a quick overview of how the funds have done, and I think then Anton's going to kind of dive into more forward-looking stuff around what we're expecting and some of the opportunities we're seeing coming up into the market. Two things I just want to point out. First of all, you'll see on the right-hand side of the screen there is a chat function. Please pop in some questions for us. We want to make sure that this is as interactive and useful for you as humanly possible. And so we want to make sure we spend some time answering all those questions. And then the second thing there is a couple of polls. If you're interested, we'd love to get your views, and that would be very helpful to us. I'm not going to spend time running through who Peregrine is. Hopefully most of you know us. But if you do want some literature on it, in the files tab on the right, there are some, our MDDs are in there, a copy of the slide deck's in there, and the company profiles in there as well, if you'd like to read that at some point in time. Right, and the final thing is we have applied for CPD points for the session, so pending obviously approval from the FSCA, I'll get in touch with everyone post the event just to get those certificates through to you. So let's dive in. So to begin with, I'd like to just quickly run you through the two funds we offer. So to be very cognizant of time, we really are a very focused investment house. I think we've spent a lot of time working out what we are good at and conversely what we are not good at. And so our expertise sits obviously in the hedge fund space, and we try to portray those expertise through our two flagship funds, which is the High Growth Fund and the Pure Hedge Fund. Now, the funds are obviously informed by the same investment process, but they have slightly different or quite significantly different mandates in the way that they go about those things, and they obviously therefore provide different outcomes for different investors. So I thought just to run through them very quickly for a refresher for those who might not be aware of them. So High Growth Fund is a multi-asset hedge fund. Really here what we're trying to do is to generate the best possible return profile for clients in the long term. Obviously, that comes with the proviso to say that this is a hedge fund, and as hedge fund managers, we believe that managing the journey, managing the volatility is equally as important. So, if you look at the performance of the fund, last 10 years, we've done 14% per annum at a vol that's significantly lower than the market. That's around half the volatility of the market. And that's certainly what we aim for in this product. I think what we're trying to do here is to compound our clients' wealth as quickly as possible without any significant and shocking drawdowns. We're looking to smooth that ride as much as possible. And if you look in the green square there, you'll see that this fund's done now well over 100 times capital for investors since inception. And I think that the secret sauce there is not swinging for the fences and trying to generate a huge single year particular return. It's rather just being super consistent, managing that downside, and trying to let compounding do its work. Interestingly, we actually last month or the month before that 100 times has now moved up to 150 times. So it's certainly done that job well for investors in the past. Pure Hedge Fund is a very different beast, and the reason I say that is this is a market neutral hedge fund. It's an absolute return mandate. So what we're looking to do for investors here is to give them consistency above all else, and that consistency we're looking for is probably aiming around sort of low double-digit returns over all measurement periods. And if you look at the performance track record of the fund, it has certainly done that. I think this is an exceptional product for people who are looking to grow their wealth over time, but have probably done the hard yards themselves already. So, people who are post-retirement, people who are looking just to take what they have made through the course of their lives, to give it to a manager who's going to look after it, who's going to make sure that they get that stable and consistent outcome they need. And there you can see the 10-year return number. Still, as I said, low double digits, but with a very, very low volatility profile. And I think that goes to it speaks to the box in yellow there, where the fund's been running for 26 years now, and we've never had a negative performance year in the fund. And that's really what we're trying to do in a fund like that. It is our low risk offering. It is about that consistency and downside protection. If I move on to just very quickly giving you an update on performance. So if I look at the high growth fund, I'll say to you that our 1 year number is solid. It's not exceptional, but relative to market, it is very much what we're kind of aiming to do. So if you look at all of the black lines, that's obviously us over the years. And this fund is, I think, very good at producing kind of anywhere between 3 and 5% alpha over what the market is giving you and over what a multi-asset balance fund is giving you. And we compare to multi-asset balance because for two reasons. One, obviously, the asset allocation is quite similar in that this is a multi-asset product. It's not just an equity long short. But moreover, the standard deviation we're looking for in this fund is very similar to those sorts of mandates. So I think it makes for a relatively good comparison. If you look at the 3, 5, and 10-year numbers, you can see we've still managed to generate significant alpha, but the overall market performance hasn't been as enticing as we would have liked, and certainly hasn't been as enticing as South Africans with a longer memory past, I don't know, maybe the last 10 years recall, and I think the opportunity that we're seeing at the moment and the positive thing that we're seeing at the moment is there are early signs that may be able to pick up quite significantly over the medium term in South Africa as fundamentals do get a bit better. So I think this is a fund that we're pretty excited about at the moment. And then if I move on to the Pure Hedge Fund, I think this really just demonstrates that consistency I was talking about. So you can see here between every measurement period, you've got a variance of, I don't know, between 10.5 and 12.5 odd percent. It is very consistent. It is going to, we aim to do these sorts of numbers year in and year out. Conversely, the point to be made here is this is not a fund that is taking a lot of equity market exposure. The mandate limit in this product is 20% net equity, and so it's not the type of fund that's going to generate a 25 or 30% return if the market runs hard. It is designed to give you these sorts of returns as consistently as is humanly possible. And I think for investors that are looking for that, this is probably the fund that we have the happiest investors in, because they really are getting what it says on the tin. And that's certainly something we hope to continue. That's the design of this product, is to just provide that inflation plus outcome over all measurement periods. Finally, just before I hand over to Anton to give you an update on sort of how we're seeing the world, I think this slide is a great summary of what we are trying to do as a business. And that is not to just generate the best possible return regardless of the amount of volatility and risk we're willing to put into the product. It is to say that whatever risk mandate we run, we want to generate the best possible outcome from a return perspective for every unit of risk that we are taking on board. And you can see there, obviously, from a volatility perspective, high growth fund volatility is higher than Pure Hedge, but significantly lower than most of the sort of multi-asset, high equity, and certainly less in all of the sort of equity-only products out there. And that's absolutely what we're trying to do here. Is we're trying to say that is your universe of options as an investor. Can we give you more return for the amount of risk that you're willing to take relative to competitors? And I mean, on this graph, we have plotted every single multi-asset, low equity, high equity, and equity fund available in South Africa with a 10-year track record. So I think it shows that we've done a pretty good job of that. That's it for me. I'm going to hand over to Anton for the more important part of this thing. As I said, please, guys, pop questions in so that we can make sure that we're answering them for you. We're going to leave a lot of time at the end to get into questions, because we want to make sure that this is something that works well for everybody and you get the best value out of. over to you.
Thanks, Alan. Good morning, everyone. Thanks for joining us. Just to start off with, I'm normally only allowed to operate Excel, so PowerPoint's quite new to me. But hopefully we can share some insights with you guys and some takeaways and just what's happening in the markets and how we're thinking about it and what we're doing about it. If we start with the recent election, I think it would be remiss of us to not just spend a minute on this. Just to be clear, none of us in the investment team are, we particularly enjoy spending time on politics. We much prefer to look at companies, analyze companies, and come up with stock ideas. But because of the importance of the election and potentially the future of the country, we naturally spent a lot more time on this over the last few months. If we were to pretend that today's webinar was exactly a year ago, and I sat here and I told you that the ANC was going to forfeit their majority in Parliament, and they were not going to team up with the EFF to get them back over the 50%, and that the DA was going to walk away with 6 ministerial positions, you guys would probably have all laughed at me, logged off, and been looking at videos on Twitter of the horrific gas explosion that happened in the Joburg CBD 3 days prior. But that's what happened. And to be fair, that's not something that we particularly saw happening. There was a lot of stuff that took us by surprise. One of which is the MK's unprecedented rise, overtaking the EFF. But I think the point here is that we cannot stress enough how good an outcome we think this is for the country, especially given the alternatives that were on the table. We think this creates the conditions and confidence for companies in South Africa to invest their capital, to create more jobs, and to deliver better growth of earnings going forward. We think in time this could also lead to better liquidity in the South African markets, which is something that's quite been draining out of the market over the last few years. And just to summarize, we think this is a good thing for South Africa, and it's a good setup going forward. Now, obviously, we're under no illusion that this is going to be a cakewalk. We've already seen the ANC and the DA bump heads over a lot of aspects. But be it as it may, we do think that this is a solid foundation for South Africa going forward. Sorry, just bear with me for a second. I think a few of you might know that we were quite bullish South Africa going into the election. The basis of that was just very poor sentiment. Valuations were very cheap. We have seen balance funds allocating more and more of their capital to offshore markets, and that created a good setup in our opinion. Leading up to the election, we bought some call options on the all share index to try and get a geared effect of a good election outcome without risking too much capital in the event that things went the other way. At the same time, we were also very aware of the risks of a so-called bad outcome. So we bought some protection on the Rand. And in the event that the Rand weakened significantly to over 20 Rand to the dollar, a significant part of our portfolio would have been hedged, and we would have walked away relatively unscathed. I'm sure you would appreciate the days before and during and after the election were quite volatile. There were a lot of leaks in the media. There were rumors of the EFF trying to get back into the government of national unity. And we naturally monitored this very closely. But when we started getting a sense that the probability of what we would classify as a good outcome increased, we started increasing our exposure to South Africa further. We bought banks, we bought retailers, we bought more Rand exposure, and then we also bought some South African bonds. As this thesis started playing out and these shares rallied, we started reducing that again and recycling it into other South African stocks. Mid caps generally lagged this rally, and if a bank would benefit from better earnings and a better consumer outlook eventually, there's no reason why a mid cap industrial wouldn't do the same. So we switched some of the more liquid exposure into some of those names that haven't moved yet. And then there was also a few shares that are largely offshore based that also benefited in the rally, and they fundamentally a stronger rand doesn't really do anything for their earnings. So we also reduced some of that exposure. And then as some of you might be aware, we ended the month of June up around 3% in high growth. We think that was a good outcome. Obviously, our job is to try and capture a lot of the upside, but also to protect the downside. And given all the uncertainty and risks around at the time, we're quite happy with that performance. We still maintain that there's a lot of attractive assets in South Africa. The reasons for that, apart from valuation, is political or structural reform. We've touched on that. The consumer outlook and interest rates, and then the situation at Eskom, and then also just asset allocation by balance funds and foreign asset managers in general. We'll touch on that briefly just now. Just starting at the rand, I'm sure all of us on this call is very aware that the rand is quite a volatile thing. What we started seeing towards the election is a weakening, and then as the positive news started coming out, a strengthening in the rand. You can see on the graph on the left-hand side, there's a clear trend of strengthening. We think the rand could probably strengthen more of these levels for various factors. One of which is the South African balance fund allocation to South African assets. You will all be aware that post the changes in Reg 28, these funds were allowed to allocate more funds offshore, and then I suppose you could probably say, understandably so, they increased that exposure. We don't have the most updated data for the second quarter yet. My sense is that they've probably increased allocation to South Africa a little bit, but you can see there just over the past few years, it's still miles below where they are. Because a lot of these funds are benchmark cognizant, we think that in time there's every possibility that they will reverse this trend and allocate more to South African assets. We don't need this to validate our thesis on South Africa in general. And we're very aware that decision-making at these larger asset management is quite tedious, and it could take a long time. But this could provide a nice tailwind to the South African market in general. If we look at positioning by foreign investors, you can see it's still negative year to date. There was massive outflows in March, and we think part of this was just taking more money out of SA in anticipation of a so-called doomsday coalition between the ANC and the EFF. What we saw after the election is some increased buying by the foreigners, but that subsequently reversed. And despite some international banks like JP Morgan and UBS upgrading South Africa to overweight, these guys are largely still sitting on the sidelines. What we suspect is that they have been burnt by Ramaphosa in 2017 previously, and they're waiting to see some tangible evidence of improvement on the ground. As we touched on, and we'll touch on in the rest of the slides, we think there's every possibility that there will be some improvement on earnings on the ground. And although South Africa is a smaller proportion of global equity indices, we do think it matters enough that these guys will come back. Excuse me. And then just to point out a recent example of something similar happening is Argentina. The Argentinian market has been decimated over the last few years. But given the appointment of President Javier Milei, their stock market has been one of the best performing markets in the world. And once again, that's not what we're forecasting for our market. it's just a case study of what could happen. We also had a lot of news flashes or rumors of massive offshore hedge funds having a lot of analysts on the ground during the election. So we're confident that there are people looking at the market. We just need to see some evidence of improvement before they buy. If we look at the SA consumer outlook, I think we're not going to sit here and tell you that everything is going fine with the consumer. I think it's pretty well known that the consumer is under a lot of pressure. We've been getting that feedback from management teams on the ground consistently over the last potentially 2 years, maybe even longer. The consumer's been through a lot, but if we look at the forward-looking picture, I think we're confident that it looks a lot better than the rearview mirror. One of the most impactful changes that we think is going to happen is interest rates. We think the SARB has potential to cut interest rates by 100 or even 125 basis points. They are currently forecasting inflation to be around 4.5% and stabilizing there. Not to get too technical, but their neutral rate is 2.5%. So if you take the 4.5%, add 2.5%, you get to a neutral repo rate of 7%, and that compares to the current repo rate of 8.25%. So we think they are 1 or 2 meetings away from starting to decrease rates. Now, a lot of that depends on what the Federal Reserve does, but we'll get to that. We also think that the Fed is very close to cutting rates there. We think the secondary risks to inflation in South Africa is pretty benign at the moment. As we saw a few minutes ago, the rand is stronger. We think there's room for it to improve even further. The oil price is very volatile at the moment, but if you look on a 1-year basis, it's more or less flat. So there's no real risks to pressure on the energy price or fuel price. And then if we look at the SARB's internal forecasts, they are still using a rand-dollar exchange rate of 18.85, which is higher than what the rand is trading at the moment, around 18.30. So if anything, there's potentially downside risks to inflation estimates or on their side. We all know that South Africa is struggling with very high unemployment rate. We are confident that in time, some of the structural reforms happening in the economy will lead to better job growth. That's obviously good for consumers. The fuel prices already started to come down once again. If the rand strengthens and the oil price goes down a little bit more, there's every reason to think there will be more fuel prices. And then just very briefly, the two-part savings release effective 1 September could also put some money back into the consumer's pocket. We don't know exactly what the quantum of that's going to be and how much of that will go towards repaying debt or consumption. But at the very least, assuming worst case scenario, everything goes towards repaying debt, the consumer will obviously save on the interest charges, which will help them. Just spending a moment on Eskom. I think we're all well aware that we've had, I think it's 118 days of no load shedding today, and I think we're going to stop counting soon and all delete the Eskom push app off our phones. It's not necessary anymore. But when we started speaking, we did a lot of work about a year ago on the electricity situation and what exactly is happening at Eskom and the outlook. And we started telling people we think a year from then, which will kind of be today, we're not going to have load shedding anymore. We were almost laughed at, and people were very skeptical about it. And that's still the case when we speak to corporates. They're still very skeptical about it. And obviously into the election, a lot of people were saying it's an electioneering tactic. But we're a month past the election now, and it's still going strong. I think it comes down to just people internally in Eskom realizing that they had to start fixing it. If we look at the unavailability of power units generation at Eskom, you can see on the graph on the top end there's a clear downward trend, meaning that there's more power available. A lot of the strain has been taken off of Eskom with corporates and private households that can afford it, that have been installing solar generation. But be it as it may, this is clearly positive for Eskom and the economy as a whole. If we just assume that Eskom generation units or volume sold year on year is going to be flat, they've had a pricing increase. We estimate around 30 billion in savings from diesel burn. It's not hard to see that they were going to show an improvement of around 50 billion, at least 50 billion of EBITDA improvement. I hope they don't prove us wrong, but that's what we estimate. And that can obviously go a long way towards repaying down their debt, which takes a lot of the burden off of the government in terms of loans into that, and that frees up capital for other areas of the economy. And then on Transnet, I would say it's less positive than Eskom, but at the same time, we're also medium-term positive on the reforms that are taking shape there, and we've already seen an improvement in rail volumes and port delays up to this stage. We think SA is cheap. We're banging the drum on SA. The SA market is volatile, and that creates a lot of opportunities for us. Recent examples include Tiger Brands and British American Tobacco, MTN, etc. But at the same time, we are still finding good value offshore. Obviously, we are able to allocate our capital into South Africa and offshore, so we think we can kind of tap into the best of both worlds wherever we see value. And largely, our investment philosophy is the same, whether it be in South Africa or offshore. We avoid sectors in offshore markets where it's too difficult to understand, or we feel like we're at a disadvantage. But we've spoken about China in the past, and the Chinese market has gone through a lot of changes. They've had some economic slowdown, which is well documented, and then which was equally well documented is the regulatory intervention in those markets. But be it as it may, if we just look over the last few years, the MSCI World, the global equity index has doubled, whereas China is flat. And given the potential in the Chinese economy and where valuations are at the moment, we're finding quite a few attractive opportunities there. One of which is Tencent. Tencent will not be new to any of the South African investors given the NASPERS process involvement, but we continue to like Tencent. And then one of Tencent's investments is PDD. PDD, for those who don't know, is an e-commerce company. They originally started off as a group buying business, and recently they've taken the world by storm through their product Temu, which is a low-cost, direct-to-manufacturer retail model. We're very excited about this model. We think this could potentially be the final version of retail, if we can call it that. Whereas retail started off in traditional channels and then shifted to e-commerce that we all know, so like Takealot, for instance. But Temu has taken it a step further, where they don't really carry inventory, but they aggregate orders on the platform and directly order from the manufacturing. We think PDD's earnings per share is going to be up over 100% this year. And if you just look at the PE graph, it's just plainly too cheap, and we're expecting some good upside off of that share. Now, just shifting to the US market quickly, it's been a very good performer this year, as many of you will know. The S&P is up 18% up to last week, and a lot of this growth has come from the AI winners and the big tech companies. And if we look underneath the surface, there's a lot of consumer-facing companies like restaurants and consumer discretionary names that have been under a lot of pressure. The market has been driven by earnings and multiple expansion. We don't think it's particularly expensive, but given the risks on the horizon, we are cautious, and we will remain cautious around looking for new companies, and especially around structurally challenged sectors. Having said that, we've been a beneficiary, or benefited from some of the beneficiaries this year, like Meta and Amazon, Google, Microsoft, and we'll continue to be cautious at looking at these new companies. But everyone in the team is kind of looking at the US and expanding our horizons all the time. Just on US rate cuts, I think everyone is sick about hearing about US rate cuts at the moment. The current lay of the land is that the market is expecting rate cuts this November by the latest. The market's pricing in rate cuts by September. If we just look at the US economy, it's still going very strong, but there are some signs of cool down. GDP growth has slowed down. There's been some revisions in prior data, and the retail sales data is not looking great. Employment rate has ticked up a little bit, but as a South African, 4.1% is still very low. Importantly, inflation keeps ticking down. It's still above the Fed's targeted rate on an annualized basis, but if you look at forward-looking inflation expectations, that means that real interest rates have ticked up a little bit, and that gives the Fed scope to cut interest rates. Having said that, this should all be very good for markets and consumer, and in a good scenario, the Fed will pull off a so-called soft landing. But having said that, we have maintained our what we call recession hedges in the long bonds. At the time we purchased it, we saw relatively attractive yields on those bonds, especially if there was going to be a normalization in those yields. And the plus side is that if there's a recession, equity markets will potentially sell off, and these will provide a nice cushion to that. And then what we would do is redeploy capital into equity markets. It's just a one slide, and it's just giving you an idea of our local to offshore equity exposure. Like I said, the global markets is very exciting. There's a lot of companies that we don't have to have exposure to in South Africa. So you can see there's a nice spread there, and we are able to take advantage of opportunities that we might find. And yes, it's a continuation of the previous slide, just to give you an idea of our geographic exposure. You'll see we like China and the US. North America is predominantly the US, but we're also looking outside of those markets, and we're finding opportunities in Europe, Western and Central Europe. I'm just going to share a recent winner in our funds, and just to illustrate the opportunities we find and how we go about it. Zeta is a agricultural holding company in South Africa that used to be part of the PSG stable. The capital allocating track record of the business is very mixed, and as a result of that, the share used to trade at steep discounts to NAV, and a lot of people was disinterested in the share. And then in 2020, after they had appointed a new CEO, we detected a shift in the tone of management, where the focus moved away from growing the business and more towards doing what is right for shareholders. We did some digging and investigation, and we soon realized that the assets that the business owns are reasonably good assets that were trading at a discount to NAV, and we started buying the share. And then soon afterward, at the time they owned a few assets, one of which being Zard, and Zard is essentially a seed and chemical company listed in South Africa, and potentially a very strategic asset for some of the global players, given their exposure in emerging markets. And then they also had a few fruit farms, logistics operations. They had some maize farms in Zambia, etc. Our thesis started playing out when the company started announcing that they were selling these assets at or above NAV. The implication of this asset trading at a big discount to NAV was that people were potentially putting a 35% discount on a potential cash holding. And the moment you realize these assets at NAV, at or above NAV, you immediately capture that discount because cash, in theory, shouldn't really be trading at a discount at all. And what has happened over the next few years is just consistent execution by management, doing good disposals on the way to winding down the company, and they are returning cash to shareholders in the form of special dividends. As you can see there, it's generated a almost 25% compound return versus the market at about 14%. So that's a good 10% of alpha for not too much hard work. The beauty about Zeta is that it was hidden in plain sight. Management communicated openly to the market about what they want to do, where they see the future, which in reality was they were going to wind it up. And we didn't have to learn brand new industries or technical jargon or anything like that. We just had to read a SENS announcement and figure out that what these guys were going to do, and then obviously you have to back management to do good deals. I think the nice thing with Zeta is we knew PSG, which as a brilliant track record in South Africa of capital allocation, was somewhat overseeing this process, given that they are still large shareholders. And then just to summarize. I think many of you know our investment philosophy, but for those who don't, we believe in meritocracy. We only try and have the best ideas in the funds at any given time. We only invest in businesses or situations which we understand. Sometimes when we don't understand it, we're willing to do the work to try and understand these situations and get an idea of what the risks and the opportunities are. And that is something that hasn't changed over 26 years of our business, and something that will continue on in the future. And I think that's all from my side for now, and I think we're happy to take some questions.
Okay, great. Thanks for putting the questions through, guys. Just a quick one for those who did struggle to log on earlier. My apologies. We will be sending out a full recording of this to everybody that registered post the event, so you will certainly be able to have a watch in your own time. But that should be coming through quite soon. Okay, so I think that if I can try and group some of the questions here just around local versus offshore. I think one of the questions that came through was a question around Transnet specifically, and how much we have seen private sector being allowed into Transnet or to collaborate with Transnet, and do we think that's going to have a positive impact?
So thanks for the question. To date, I might have touched on it previously. We haven't really seen any movement on that front yet. We've spoken to a few people in the industry and experts on the field, and the reforms at the moment are quite slow still, but they've appointed new management, and our understanding is there's a lot to figure out and a lot to fix. So we think in the medium term these reforms will still happen, but unfortunately it's still a little bit slow at this stage. But we're positive it will come in the medium term.
I think just an interesting point on that. We had a conversation, one of our PMs had a conversation with the guys at Business Leadership South Africa a while ago. And just on Transnet specifically, they were saying that what has been quite a positive idea from Transnet management team is obviously procurement is an issue. For the reasons we all know, around whether the procurement team are able to actually get the spares, replacements, parts, whatever that they need. But secondly, obviously around pricing and some degree of corruption and price inflation, etc. So one thing that the new Transnet management team have implemented, which seems like quite a clever little fix, is to get hold of their users. So essentially, the big shipping and freight use businesses, like a Kumba or any of the mining houses, etc., and to say to them, instead of us going out through our procurement department to look for these various spare parts that we require, we are going to ask you to acquire them for us, deliver them to us, and we will then credit you with essentially a rail usage credit for that amount. And by doing so, they've managed to obviously cut out significant amounts of price inflation, but B, make sure that the expertise of the people that are acquiring these things are fit for purpose. So it definitely sounds like from conversations that we've had that the new management team is significantly more adept at managing the business than the previous one was, and they are looking at innovative ways of trying to come up with solutions for the company. So it is certainly moving slower than Eskom, but nonetheless moving somewhat in the right direction. Then the second question was just around the two-pot system and what impact we think that might have on particularly the large kind of incumbent balance funds, and do we think we're going to see pricing pressure in the market because of that development?
Yes, thanks, Alan. So we've done some work. We read some reports, and it's obviously quite tricky to know exactly what will happen at the moment. We've seen estimates ranging from 45 billion to 60 billion withdrawal at this moment. Now, given a lot of the balance funds have already allocated a lot of their assets to offshore markets, we think the impact on the South African market will be smaller. But as I mentioned earlier, we don't know for sure. And then, as I touched on in the presentation, we don't know. Let's assume it's a 45 billion withdrawal. How much of that is going to be used or consumed by the consumers? So are they going to go to the shops? How much of that is going to go down to repaying debt? And it also depends on what the income group of the withdrawals are. Obviously, a higher income group will probably withdraw less of their accepted or allowable allocation. But be it as it may, if it's going towards debt repayment, at the very least, the consumer will save on the interest charges, given the high current interest rate environment, which would free up some disposable income to spend.
Okay, awesome. Then, just two quick questions that I'll probably try to answer here very quickly for you. So, Lawrence, you asked what impact would 100 basis points lower repo rates have on Pure Hedge's return profile? I think that the obvious answer is that the cash portion of the portfolio, and it does run relatively high cash holdings, will have some reduced yield in it. I'd say to you that that's probably in the region of 30 to 40 basis points of reduction in yield from that bucket. But I think the counter to that is obviously that you might find that other elements of the portfolio start doing a bit better if we do see rates getting cut, particularly the equity content there. And then Morgan, you asked if we're looking to launch an offshore hedge fund. And the short answer is yes, absolutely we are. I think two things worth mentioning here is, number one, we believe that we have a very good skill set in managing hedge money. If you had asked me, are we looking to launch a long-only product, the answer would be no. And the reason I say that is because I think the mindset of a hedge fund manager and the way a hedge fund manager thinks about opportunities is actually very, very different to the way a long-only manager would think about opportunities, particularly in the thought process around being relative a benchmark. I think if I asked Anton right now for the weighting of anything in the top 40, he wouldn't be able to answer that question. And I'm very glad he wouldn't be able to answer that question, because we are looking for absolute return profiles. We are not looking to outperform a particular benchmark. I can tell you for free that if the index was down 30 and we came to our clients and said, look, but we're only down 25, so we've done well, they wouldn't agree with me in that statement. So yes, the answer is, I think if we do look to expand our global offering, it will certainly be in the hedge space. What form that will take is still to be decided. I mean, you particularly asked about Pure Hedge there as one of the strategies. I think the limitation around a global market neutral product is you do have to accept that there will probably be a lower return profile than Pure Hedge provides us in rands. I mean, I did ask this of the PM team a while ago, saying, I think if we can get a 10 to 12% consistent return in a product in dollars, I have no doubt clients would love us for it. And they said, yes, absolutely they would, but that's actually a very, very difficult product to bring to market, because you can't, to find that kind of return profile is very difficult in developed markets. And if I look at the kind of market neutral or absolute return mandates that do exist out there globally, that number is closer to kind of 5 or 6%. And truthfully, I don't think clients would be as excited if we came to market with a product that could do 5s or 6s in dollars. And so I think if we do look into, and we certainly are trying to look into the offshore market from a dollar denominated product, I would imagine it's going to look more like high growth than Pure Hedge. Then just moving on quickly, there were two questions around what do you think, if we have Donald Trump coming in as president of the States after elections, what impact do you think that's going to have on the market? And secondly, what impact do you think that might have on relations with China?
Thanks, Alan. I think, it's a very interesting space at the moment. And I think last night we saw Joe Biden is officially going to drop out of the race. I think from a US perspective, it will definitely be good for domestic companies. We obviously saw after he became president the previous occasion that the markets rallied hard. He's generally going to be very pro-business for the US. On China, yes, I think we already saw last week or the week before that after the assassination attempt and Donald Trump's probability of winning the election shot up a lot as a result of that the Chinese shares were under pressure. I think at this stage it's largely in the price. Our investment theses in companies are never really too political driven. So yes, it will create short-term noise. But we think Temu or PDD will grow earnings by 100%. We think Tencent will grow their earnings regardless of what the president is. Temu will definitely be more exposed on that front. There's already talks of changing the tariff structure in the US, which will also slow down growth there. And the US is a very important market for Temu, but also they are expanding globally. So it's not just a US business. But in short, yes, it will probably create some short-term noise, but it's not really something that scares us. Obviously, if Donald Trump becomes president again, and there are some very hard lines or harder lines being drawn, we will obviously revisit our thoughts and act accordingly.
Okay, now I've got a in-depth question that I'm actually going to read verbatim, but otherwise I'm going to muck this up because it's way above my pay grade. What is your house view on the potential risks of the US long-term bond exposure due to the large pro-cyclical fiscal deficits being utilized? Does the increased long-term bond issuance make you concerned for a possible bear steepening in the US yield curve, even if the Fed starts reducing interest rates in September?
Well, thanks, Ron. That's an interesting one. Yes, I think a lot of people have been scratching their heads around the policy in the US at the moment. It's definitely pro-cyclical, which is unusual. I think our thesis is more around using this as a hedge, as opposed to allocating a massive portion of the funds in this, taking an interest rate view. Having said that, we think the yields compensate you well enough at the moment. And obviously the market is also aware of the policy in the US at the moment. So you can make the argument that a lot of this has already been priced in. Naturally, if for whatever reason there's a pickup in spending and increased deficits, it will definitely be negative for the yield curve. But at the moment, as I mentioned, we kind of see it as a hedge with a yield, as opposed to a bet that the yield curve will come down.
Okay, then I've got one more for you. So Louise asked for a hot share tip for his PA portfolio. What do you got?
I've got the Peregrine High Growth Fund for you.
Nice.
No, just we speak a lot about mid-cap names, and I don't know if I want to share too many names with you, but if you just look across the mid-cap sector in South Africa, and even names that were previously would have been seen as large caps and now probably classify as mid caps. I think we're finding a lot of opportunity there. We often cases buy these shares and start engaging with management. I wouldn't call ourselves activist investors per se, but there's a lot of engagement, and we try and convey value unlocking strategies with management. Sometimes they listen, sometimes they don't listen. Sometimes we keep at it, sometimes we just let it go. But just look across the mid-cap space in industrials, food producers. There's a lot of opportunity, and obviously, if we think something is gonna go up a lot in the short term, we will buy it for the funds. But oftentimes there is no real catalyst in these names. You just buy it because it's cheap and the dividend yield compensates you well enough, and you will make a total return or a shareholder return of north of 20% in many of these instances. So you don't even need a re-rating. But unfortunately, Louis, I don't have a hot tip to share for you at this stage.
Okay, two final questions that I think we're probably going to wrap up. But a quick one was asking, are we looking at India as a potential investment destination for the fund?
Thank you. We have looked at India in the past. We've also looked at Saudi. It's one of those markets that is very hot at the moment, given the positive outlook and the demographic situation in India, and I think a lot of people after they left China, they went to India. It's hard for us at this moment to fully understand those markets. There's cultural differences and other differences that we don't fully understand yet. It's not markets that we actively look at the moment. We find enough opportunities in our local market and on the more traditional offshore markets, if you will. But obviously, there will be a point in time where it's going to be difficult to ignore these markets. It's just hard to square the long-term growth potential of these markets with the current valuations, because the valuations are quite rich in a lot of these things. Saudi is the same story. It looks good if you just look at the numbers, but if you look at what you pay for it, it's quite hard.
And then just a final question on what do you expect the effect of the SARS investigation into the legal and tax loopholes of Temu and Shein might be? Shein.
I don't have a firm view on that. I am aware that these companies they did find loopholes around it. They've done it in pretty much all the markets in the world. I do think that if they've been doing slipping through the cracks, SARS will stop it. I think we all know that SARS are pretty good at stopping loopholes. But I think at the end of the day, if you just look at the value, that Temu is able to offer their customers, the shipping times or the waiting times is quite long compared to something like Takealot in South Africa. But if you just look at the value or the price that you can get a lot of these things, maybe it will slow them down a little bit. But ultimately, a consumer that's hunting for value won't be perturbed. And I'm sure if there are any changes, Temu will kind of notify their customers upfront about any increased duties or tariffs or charges.
Okay, great. Guys, I think I'm going to call it there. We don't seem to have any more questions coming through, and we are getting very close to the end of the scheduled webinar. I'm sure you will have lots of very exciting things to do on this Monday morning. But thank you very much for joining us. We really do appreciate your attendance. And as I mentioned earlier, the slide deck is available in the file section of this chat. And likewise, we will be applying for the CPD points. So I'll get in touch around that once we hear back from the FSCA. And then just a final request from my side, if I may. This is only the second webinar we've ever done. So we would like to make sure that we are giving you content and actually making this useful, a useful use of your time. So any suggestions, any recommendations, criticisms, etc., please let me know. It's always nice to learn, and we hope to iteratively get better at this as we go. And that would be really helpful if anyone does have any input for us. But thank you very much for your time, and enjoy the rest of the week.
Thanks, everyone.